Hello, friends and subscribers. Welcome back to another episode of Readings in Impact Investing. My name is Daniel Rosehill, and this is a brand new podcast and YouTube channel solely intended to help spread the word of impact investing and get these good reports that come out regularly in the industry off the page and into your ear if you're somebody who prefers to get their content and their continued professional development material in that manner, or you perhaps are not able to read for accessibility reasons such as a physical limitation. In any case, both are very much the reasons why I'm trying to do this. And I'm probably going to be listening to these recordings myself at the gym, as weird as that is going to be, listening to myself on audio. So today I am going to jump back to the Impact Taskforce State of Play 2023. This is the kind of end of year report that they came out with in December, which is almost over. And essentially, I have already narrated the entire report, including the glossary. But what I'm going to do now is go through Annex A, which lists the success stories in mobilizing domestic pools of capital for impact. And we're going to be taking a look at these. And these are basically best practice samples for success of how this has actually worked. Vehicles designed to mobilize domestic pension funds for impact and EMDEs. Asset class, description, country. We've got three headings. Asset class, public equity. Description, Mobilist, a flagship initiative by the UK government and FCDO. Mobilist, Mobilist, helps products to list on global and local public exchanges. To date, the programme has made 2 commitments, with 12 more in the pipeline and or under review. Mobilist invested 25 million British pounds in the Thomas Lloyd Energy Impact Trust plc, the first ever EM's renewable energy fund, which went on to raise $111 million in December 2021 at IPO. Through partnerships with stock exchanges in London, Singapore, Johannesburg, Sao Paulo, Manila, Mexico, and Nigeria, Mobilist is helping to channel more capital for sustainable development via products listed on those exchanges. And the relevant geographies are the UK, Singapore, South Africa, Brazil, Philippines, Mexico, and Nigeria. Private debt example. Managed Co-Lending Portfolio Program, MCPP One Planet, is a $3 billion global loan syndication program for climate-smart investment aligned with the Paris Agreement. Developed by the IFC, the facility enables institutional investors to directly provide capital for sustainable lending in EMs, emerging markets. Since its launch in 2013, MCPP has provided over $10 billion from 11 investors and provided financing to more than 200 firms across 55 developing countries. Private equity, venture capital, and SMEs. This one is from Ghana. CGABA Fund of Funds Impact Investing Ghana, IIGH. The CGABA, that's CIGABA Fund of Funds, is a $75 million blended finance vehicle that will provide funding for West African venture funds and SMEs. 75% of the funding is local and focused on investing in SMEs. The use of local currency is designed to encourage local market development and capital mobilization from Ghana's pension industry. The vehicle consists of 2 tiers of capital, a senior tier structured as preferred shares with return expectations based on a 10-year government bond rate, and a second tier covering a percentage of first loss from donors or DFIs. The vehicle is supported by Impact Investing Ghana, with support from the Global Steering Group for Impact Investments, GSG, FMO Ventures, and the Research and Innovation Systems for Africa Fund of UK International Development. And we have one more example from Ghana in the realm of private equity, venture capital, and SMEs. Growth Investment Partners GIP Ghana is a local currency financing vehicle launched by BII, British Investment International, in July 2023, designed to provide long-term capital that addresses a financing gap for Ghanaian SMEs, which account for over 90% of all employment. Through a $50 million commitment, the vehicle will support up to 150 SMEs in Ghana within the next 15 years. An example of private equity, venture capital, and SMEs again, this time from Nambia. Credit Risk Guarantee Scheme Bank of Zambia in 2022. In 2022, the Bank of Zambia, BOZ, signed a Memorandum of Understanding with the Zambian National Advisory Board for Impact Investment to design a credit risk guarantee scheme to provide affordable credit to formal and informal SMEs operating in the agriculture value chain. Thanks to a grant from C3 Collaborative, NABII and partners are assessing demand and supply side gaps to create a mechanism that addresses the real and perceived risks, preventing commercial banks from lending to MSMEs. In time, the mechanism will seek to draw in capital from domestic pension funds who are looking to diversify their portfolios and increase support for local sustainable investment opportunities. Private equity venture capital SMEs again, this time Nigeria. Wholesale Impact Investment Fund, Government of Nigeria. In May of 2023, Nigeria's government pledged to support a 50% stake in a $100 million initial investment to establish a $1 billion impact wholesaler benefiting local SMEs and fund managers in the fields of health education and agriculture. Sponsored by the Impact Investors Foundation and with the research support from the Global Steering Group and design funding from GIZ, the wholesale fund seeks to raise co-investment from Nigerian pension fund and other investors. In the category of infrastructure, we have institutional investor-public partnerships. Legal and regulatory barriers in many African and other emerging markets prevent domestic institutional investors from investing in domestic infrastructure projects. Yet without the ability to harness institutional investment, meeting these gaps will be virtually impossible. Africa alone needs to mobilize $3 trillion for its nationally determined contribution (NDC) projects by 2030. To address the challenge, the African Green Infrastructure Investment Bank, Africa Investor, the CFA Asset Owners Council, and global law firm DLA Piper collaborated to develop the Institutional Investor Public Partnership Legal Regulatory Framework. IPP are partnerships between governments and institutional investors designed to fast-track, de-risk, and scale private capital participation in green infrastructure projects. Under the program, a government climate procurement authority pre-selects investors to develop the procurement project pipeline feasibility and appoint a contractor for domestic climate projects aligned to the country's NDCs. Through a partnership with the International High-Level Panel on Water Investments for Africa, IPPs will help mobilize $30 billion for water investments in Africa, with more partnerships on the way. IPPs were endorsed in June 2023 by the New Financial Pact Summit Private Sector Recommendations as a means of mobilizing private capital at scale in EMDCs. And I think I'll leave it there because I'm trying to, based on feedback from the first couple of people kind enough to listen to this and give me some feedback, people say they want it to be relatively short, these bites of information. So there's another whole 2 pages of examples, and I will keep those for a future episode. So I hope those have provided just some ideas for how all this public-private partnerships to drive capital for the achievement of the SDGs, especially in emerging markets, actually works. And again, if you want to get in touch with me for any reason, give me feedback or suggest a report or send a report, please do consider contacting me. It's public@danielrosehill.com, ROSEHILL. Thanks very much for watching and have a pleasant day.